With stockholders' equity, there are different types of dividends, and this is going to look at stock dividends. Now to review, there can be cash dividends, stock dividends, property dividends, and there's even the concept of liquidating dividends. This is going to focus on stock dividends and how it differs from other types. As with cash dividends, there are important dates, but the declaration is different. With a cash dividend, we're recording a liability, a dividend payable, but with a stock dividend, it's simply a reassignment of equity, and it records a distributable shares. At the same time, it decreases retained earnings. There's a date of record. You may hear the term ex-dividend date. This is usually 2 days prior to the date of record when we're determining who is going to get shares. There is no journal entry required, just as with the date of record with a cash dividend. And then the date of distribution. It's not a date of payment. It's a reassignment of equity. It removes the distributable shares, and it's going to increase your common shares. Little important terminology: the common dividend payable, cash liability, or a cash payable dividend is a liability. Property dividend payable is also a liability, but a common dividend distributable, a stock dividend, is not a liability. It's just a different classification of equity because nothing ever is distributed outside the company. It's merely a reassignment of equity. So what do we mean by this? Remember the two basic classifications. There's contributed capital and internally generated capital. So we're reassigning some of that internally generated capital or earnings that's sitting in retained earnings, because remember, dividends all come out of retained earnings, and we're moving it to a contributed capital account. Kind of a strange concept at first. There are also some rules to prevent a little earnings management, and that has to do with a small stock dividend. If it's less than 25%, you record it at its fair market value, which means it's going to eventually be in common stock at par value, and then there'll be some in an additional paid-in capital excess of par account. But if it's a large stock dividend, if it's 25 or higher, you record it at its par value, and this is a rule that's in place to avoid some manipulation of earnings. The small stock dividend, let's look at an example. Master Corp declared a 10% stock dividend of $1 par common stock when the market value was $5 a share. Issued and outstanding are $50 million, and that's important. If you recall, it has to be outstanding to receive the dividend. So because it's 10%, it's below that 25% mark, it's a small dividend, so you want to think about this first. When you hear stock dividend, first determine if it's small or large. It's 10%, so it's small, which means the rule says you record it at its fair market value, whatever it's sold for on the stock market. So how many? If you have 50 million outstanding, you declare a 10% stock dividend. That means 5 million new shares distributed to the shareholders. Retained earnings decreases, and common stock distributable, not payable, it's a different equity account, and the additional paid-in capital then goes into, then the remaining above par goes into this amount. It results in a decrease in retained earnings by the fair market value of the stock, but there is no change in total shareholders' equity. This is how it differs from other types of dividends. Now let's look at Master Corp declared a 50% stock dividend. Dollar par, stock market value was $5 a share, issued and outstanding the same amount, 50 million. But first you have to determine, is it small or large? Because it's over that 25% mark, you can only record it at par, not fair market value. So there will not be a large addition to an APIC account. In this example, there are 25 million shares. Just coincidentally, it results in the same amount as the last example, although it will not always be. But the entire amount is going into a common stock distributable, but it will never leave your company as a cash dividend would. You're not paying anything out. There is no change in total shareholders' equity. You just moved it from retained earnings, the accumulated earnings, to a contributed capital category. So in a sense, you can actually think of this as a capitalization of retained earnings. But that's discussed more in an advanced accounting class. Key to remember, small dividends are recorded at fair market value. Large dividends must be recorded at par. And it's just a coincidence in this example of the retained earnings is the exact amount. There are two main equity categories. Contributed capital, you have capital stock recorded at par, and then additional paid-in capital excess of par, that's paid-in capital or contributed capital. Owner's contributions, and then created capital or internally generated, that's retained earnings, and that other advanced concept, an account you may see in some financial statements, it's called accumulated other comprehensive income, to be studied later. So let's see a side-by-side comparison. With a cash dividend, the declaration is going to be a liability. The contributed capital with a stock dividend, it's different. Declaration is a liability goes up. At payment, the liability and the asset go down out the door, and the created capital, the retained earnings, is decreased. But with stock dividends, nothing is ever distributed outside the company. You simply move it from retained earnings to contributed capital. Cash dividend is a distribution of earnings to the owners, while a stock dividend is a capitalization of retained earnings to a paid-in capital account. Kind of a strange concept at first. But in the end, all dividends come out of retained earnings.